What if you could learn how to invest like the greatest investor of all time? A man who turned $100 into over $100 billion. A man who still lives in the same house he bought in 1958. And yet owns companies that touch your life every single day. His name? Warren Buffett. And today, we're breaking down 10 timeless investment rules that built his fortune and can completely change the way you invest. Grab a notepad, because these lessons aren't about luck, they're about strategy, patience, and discipline. Warren Buffett, often called the Oracle of Omaha, didn't build his empire overnight. He followed principles rooted in logic, patience, and emotional control. In this video, we'll dive into his 10 golden rules, each backed by real examples, from Coca-Cola to Apple, and see how you can apply them to your own investments. So, let's start with Rule 1, the cornerstone of Buffett's philosophy. Rule 1, never lose money. Warren Buffett's first rule is simple. Rule number 1, never lose money. Rule number 2, never forget rule number 1. Sounds obvious, right? But what Buffett really means is, protect your capital. He believes your first job as an investor is not to make big profits, it's to avoid big mistakes. In 1999, during the dot-com bubble, everyone rushed to buy tech stocks with no earnings. He said, "I don't invest in what I don't understand." When the bubble burst, billions were wiped out, but Buffett's portfolio remained stable. Lesson: don't chase hype. If you don't fully understand how a company makes money, stay away. Rule 2, invest in what you understand. Buffett calls this his circle of competence. He invests only in businesses he fully understands, from how they make money to what drives their growth. For decades, he stuck to simple industries, consumer goods, insurance, railroads, and banking. He didn't buy Amazon or Google early, not because they weren't great companies, but because they were outside his circle of competence at the time. Instead, he invested in Coca-Cola, a business he could explain in one sentence. They sell happiness in a bottle. Lesson: know your limits. The smaller your circle of competence, the better your focus, and the fewer mistakes you'll make. Rule 3, buy great companies at fair prices. Buffett often says, it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Many investors chase cheap stocks, but Buffett looks for quality. He wants companies with durable advantages, what he calls economic moats. Example: when Buffett bought See's Candies in the 1970s, he paid a higher price than usual, but the brand had loyal customers, strong pricing power, and consistent profits. That one investment has produced over $1 billion in profit since then. Lesson: don't just look for bargains, look for great businesses that can compound wealth for decades. Rule 4, focus on long-term value. Buffett's favorite holding period? Forever. He believes in long-term investing, not trading. Buffett often says, the stock market is designed to transfer money from the active to the patient. Example: he's held Coca-Cola since 1988. Even after market crashes, recessions, and global events, he never sold. Today, Berkshire Hathaway earns over $700 million a year in dividends from Coke alone. Lesson: if you find a truly great business, hold on to it. Let time do the heavy lifting. Rule 5, be fearful when others are greedy. This rule is pure Buffett wisdom. When markets are euphoric, when everyone's buying, that's when he gets cautious. When panic strikes, that's when he starts buying. Example: during the 2008 financial crisis, while others were terrified, Buffett invested billions in companies like Goldman Sachs and General Electric. Years later, those deals paid off massively. Lesson: market crashes are opportunities in disguise. As Buffett says, opportunities come infrequently. When it rains gold, put out the bucket, not the thimble. Rule 6, keep cash ready for opportunities. Buffett always keeps billions in cash reserves, not out of fear, but for flexibility. He knows that when markets fall, the best investments go on sale, and having cash means he can move fast. Example. During the 2020 pandemic crash, Buffett had the power to make billion-dollar decisions while others were scrambling for liquidity. Lesson. Always keep some cash on hand. Liquidity gives you power when others are desperate. Rule 7. Ignore market noise. Buffett rarely watches stock tickers or financial news. He doesn't care about short-term market moves. Why? Because the market is emotional, full of greed and fear. Example. When media headlines screamed about the death of the economy during market crashes, Buffett stayed calm and continued buying. Lesson. Focus on business performance, not daily price changes. As he says, in the short run, the market is a voting machine. In the long run, it's a weighing machine. Rule 8. Diversification is for the uninformed. This one's controversial. While most people preach diversification, Buffett believes that concentration builds wealth, if you truly know what you're doing. He once said, diversification is protection against ignorance. It makes little sense if you know what you are doing. Example. At times, over 40% of Berkshire's portfolio has been in just a few companies, like Apple, Coca-Cola, and American Express. Because he invests heavily in what he understands best. Lesson. Don't spread yourself too thin. Focus your money where your knowledge is strongest. Rule 9. Invest in people you trust. Buffett doesn't just invest in companies, he invests in management. He looks for leaders with integrity, intelligence, and passion. Example. He's stayed loyal to CEOs like Ajit Jain and Greg Abel for decades because they run their businesses as if they owned 100% of them. Lesson. Great management turns good companies into great ones. Never underestimate the power of trustworthy leadership. Rule 10. Keep emotions out of investing. Finally, Buffett's most human rule. He says the biggest enemy of investors isn't the market, it's themselves. Fear and greed destroy more portfolios than bad stocks ever could. Example. In every market crash, most investors sell in panic, while Buffett quietly buys. He once said, if you cannot control your emotions, you cannot control your money. Lesson. Be rational, be patient. Because success in investing isn't about IQ, it's about temperament. Just think about this. If you invested $10,000 in Berkshire Hathaway in the 1960s, today, it would be worth over $300 million. Not because of luck, but because of time and conviction. And maybe the greatest irony of Warren Buffett's success is that he's lived one of the simplest lives imaginable. He drives the same car for years, eats breakfast at McDonald's, and still lives in the modest Omaha home he bought for $31,500 in 1958. Once he said, success is not about having more, it's about needing less. In a world obsessed with fast profits, Buffett teaches the opposite, that simplicity, patience, and discipline are the real superpowers of wealth. So, as you move forward on your own investing journey, remember these 10 rules aren't magic formulas. They're habits. They work only when you live by them, not when you just quote them. Be patient when others rush. Be rational when others panic, and focus on owning great businesses, not chasing trends. Because at the end of the day, Warren Buffett didn't just build wealth. He built a philosophy that proves that slow and steady doesn't just win the race, it owns it. So take these 10 rules. Live them. Let them guide your financial journey, not just for a few months, but for a lifetime. Because as Buffett says, the best investment you can make is in yourself. Thank you for watching, and if you found this inspiring, don't forget to subscribe.